Hey everybody, good afternoon. It is Saturday, November 19th, 2022. It is about 5 p.m. New York time, and I hope everybody's been doing well. And again, I know I say this every time, but I apologize about my absence on the channel. But you know, like I said, uh, I trade and I don't monetize my channel. So I did want to make a video here. So this will be a little bit different. So this is basically a 5 minute day trading scalping strategy that I'm testing and been using on futures. So I'm in one of my previous videos, I was telling you that I was dabbling a little bit in these stock futures. So that would be like the mini S&P, the mini Dow, the mini Nasdaq. Those are the three primary ones I'm looking at. So these are, like I said, traded as futures on the Chicago Mercantile Exchange. So you have to just find a futures broker, um, and besides that, you open an account just like you would with Forex or anything else. So I'm going to go through this, show you a couple of examples, try to keep it really simple. So I have not tested this in Forex. My suspicion is it may not be as successful in Forex, but I'm trying to perfect it or at least get it as good as I can in these markets, and then maybe at some point I will go ahead and test it a little bit more in Forex. But I think it's going to be a little bit different in Forex just because of, again, the kind of the decentralized nature of Forex and the 24-hour market, etc. So let's get into this, and first thing we'll do is just show what's on the chart here. So this white box right here represents, so the left edge of this box represents the New York Open for these markets. Now these markets are traded pretty much 24 hours a day, similar to Forex, but obviously the heaviest part of the volume, as usual, happens during the New York session, which runs from about 9:30 a.m. New York time until about 4:30. Okay, so the left edge of this box represents 9:30 a.m. New York time, and then I set it. This is an indicator; it's a session indicator for MT5 that I have, and I set it out about 5 hours later. So you can adjust the right edge of this to set it to whatever time you want it to look at. The most important is the left edge. And again, I have it out about 5 hours out during the session. So it doesn't even cover the whole session, just takes you from the opening until early afternoon. Because remember, this is only a 5 minute chart you're looking at. Okay. And the one indicator I'm using here is the stochastic. And I know you can't see the left edge of my chart, but it's set at 14, 3, and 3. In fact, I guess I can bring that up and just show you. So there you go. I have it set at 14, 3, and 3. This is really just the standard settings. Okay, I really didn't change anything here. Okay, so that's all I'm using. And so the basic strategy is this. When New York opens, so let's start from, I guess, the right edge of the chart here. In this case, you're looking for one of two things. You're either looking for divergence coming out of the overnight session, which, again, ends at 9:30. When New York opens, or when Chicago opens, actually. These markets are traded in Chicago, so the opening time is 8:30 Chicago time, and like I said, that's 9:30 New York time. And you can see basically we were rallying up during the night, during the overnight session, then we come into the New York session, and we have price divergence here. It's not really super divergent here, but basically this high right here is a little bit lower than this high. And the other nice thing is the stochastic is up above the 80 level on the chart, which theoretically represents an overbought area. Now that in of itself doesn't mean anything, but if there's divergence, it certainly is more powerful. So based on this setup, you would just enter a short at the open. And you'd put a stop. Now, the one thing you have to remember, these are 5 minute charts. Very often you're going to get price start to pull down and then turn and the market makers are going to try to tap and stop people out. So because if you just go and just put your stop just above this high, it's a very high probability you're gonna get stopped out because it'll come back, and you can see it did right here. And remember, you're trading on a 5-minute chart, so this is a very small area for a stop loss. Okay, so just between this candle right here and the spread, it's very high likelihood you'll get stopped out. So I would recommend maybe going out to a 30-minute time frame and finding a better area to put your stop, or just put it somewhere higher. Maybe you could use like an ATR indicator. In fact, let me see here. Let me put the ATR indicator on here. Okay, ATR, we're going to set to 14. Okay, cool. And so at this point, the ATR, let's see what it was worth. So at this high, it was about 8.5 points. And let's say the spread was 3. So let's round it to 9, and then let's say the spread was 3. Now this showing 10 right now, but it's because the market's closed. But let's say you had a 3-point spread, so you would set your stop loss at least 12 pips above this high, or 12 points above this high. All right, so you can use the ATR or whatever else you want to do. Just be careful not to put it too close, because again, on a short time frame like this, any retest of your entry area is going to knock you out of the trade. Okay, just because again, the market makers are watching those areas for stop loss, and just with the spread and everything, it's going to be a problem. So let's assume that you have your spread and your stop loss properly seated here. And you can see what happened. We had that divergence and the market just fell off. Now in this case, it fell off all the way down to here. If you had gotten in, let's just say realistically, maybe right here, and if you happen to ride this thing all the way down to the bottom here, that is 45 points, which for one contract this is the E-mini S&P, 45 points on that is almost $250, probably under like $220 a contract. So for 43 5-minute bars, so there's let's see, there's 12 5-minute bars in an hour, so this is just over 3 hours. You would have made 45 points. Okay, and you could have just continued to ride this down until you saw maybe divergence at the other end, which you really actually didn't even get much divergence here, but you could ride it all the way back down into the oversold area at the other end and then exit. You could maybe draw a trend line on here if you wanted to, wait for a break of the trend line, or if you got divergence at the bottom here, you could have actually, maybe we do have divergence. Let me get the crosshair tool. Not really, because this thing's way down low here, and you really don't. So whatever exit procedure you want to get out of this, you certainly can, whether you're using a fixed profit level, or if there is divergence at the other end, or like I said, using a trend line or whatever. Okay, so that's basically the strategy. Now there's two ways. There's either divergence or there's continuation. So let me see if I can find one that's continuation here. So this one basically qualifies as continuation. So basically, coming into the New York session, we have this downtrend. The market opens lower, okay, right here on this candle, this red candle right on the edge of this box. Here's your opening candle. And if you go and look at where the stochastic is, the stochastic at that point is right here, okay? And so this one, what happens is, if you are seeing the stochastic painting basically in between the oversold and overbought lines, very often you're going to see a continuation, because this area in between just basically represents a little indecision consolidation area, okay? And that is what happened. The market did continue to go down, and then we made this new low down here, And we do have divergence on this one. So the market came all the way down to this red candle right here, which is divergent between this low and this low. So this, potentially would have been your exit point right here. Okay? So basically, you're looking for, if the market is above, in the case of a short position, above the 80 level, or in the case of a long position, below the 20 level, when New York opens, look for divergence and then trade in the opposite direction. Okay? Let me see if I can find another one here. Okay, so here's another one. So here's the open. You can see we're rallying right up to the New York Open. And then look at this. This is perfect divergence right here. This high right here, you can see this green wick where this price wicks out right here. Okay, right at the edge of the chart. It might be a little hard to see it with this white box, but there's a big green candle right here. The wick actually pokes up above the box. And then, but look down here, that area on the stochastic. Look at the divergence in price, right? If you don't know what divergence is, simple regular divergence is basically, in this case, price makes a new high, but the oscillator does not make a new high. It's diverging. And what that's suggesting is potential weakness in the price. Okay, and then boom, we had this huge collapse. And this ended up going just inside this box, ended up going for 71 points. So again, this is $350 a contract on this E-mini S&P. Okay, that's $350. Because 70 times 5, $350 per contract on this E-mini. Okay, so again, guys, ideally, what you want to see at the open is price either above the 80 line, up in this overbought area, or below the 20 line, this oversold area. And you want to try to see divergence of that price where it is just before the New York Open or at the New York Open. And do you see divergence compared to a previous high? And this is a very obvious case. And in this case, you do. So you would just immediately take a short position here right at the open. Again, you want to put your stop. You want to take this high of this high here, and again, use your spread, whatever the spread is, plus the ATR if you want. Again, just don't put it too close. Now, in this case, price never came back. Okay, it just collapsed here. You never got a retest to this area. So even if you had put your stop here, you would have been okay. But many times you are going to see this break lower and then come back and retest this area again. If you have your stop right here, very high probability you'll get stopped out, only to see it go in your direction. Now, you can, of course, get back in if you happen to be looking, but there's just no need to take that kind of a loss, because you put your stop loss. So now you've got to, make that money back. What you just lost has got to come out of that successful trade instead of it just having be, drawdown and just, an open drawdown that, quickly comes back. Now, you're going to get some days where price kind of chops around. Here's one here. It's a little bit annoying. Okay, but we still had essentially divergence in price. Okay. So at the open here, you can see, let me grab my crosshair tool. Okay, so you can see here, when the market opened, again, price was right in between. It was right here, okay, in between the overbought and oversold area. So this would suggest a continuation, and in fact, it did go down. Let's see how far it went. It's not too far here. It's only about 11 points, okay? And then when it hit this low down here, we had divergence, right? Because you've got this low right here compared to the previous swing low, which was back here, okay? So we did have divergence, and the price did go. This is just a really choppy day. As you can see, it went up, it came down. And you're going to have days like this where you might get some whipsaws in and out. But, that's okay. No strategy is 100%. Let's just see if we can find another one. You get the picture, though, guys, right? So here we are. Okay, so we were heading up through into the opening session, and then we had some divergence here, right here, just before the open. We had this high candle right here, this red one, and it's clearly diverging compared to the next one. You have to look a little close because you're not dealing with big areas, but right here, here's a divergence, right? High, lower high, and then boom, price fell off. And then we came down here, made this low. Okay, we made another low, and you can see we had divergence at the other end. So when it came down and made this low at the close of this red candle, you look down here, that was right here, and we have divergence. So again, this low right here is higher than this low of the previous candle. So if you're in there and you're looking for that, that would have been your signal to exit at the close of this candle because it's diverging right here. And sure enough, it did pop higher. Okay, now you potentially could re-enter trades, just continuing this as long as you want. Again, if you just talk about inside this white box, there's technically another entry right here. Okay, because again, we had divergence happen again right here on these highs up here, and then the price fell off again. All right, and we came down again, and we had divergence. Did we get divergence here? Not really, because this green doji here made the low, and that is at the base of this. So we didn't really get any divergence. See, we popped higher. So, you have to just be very careful, decide what you want to make on the trade. This is a great candlestick formation, this little doji right at the bottom here. So that means there's a lot of buying interest. So potentially if you saw just this candle formation right here anyways, hopefully you would think about maybe exiting, just because that's a pretty bullish formation at a low when you get that little you get price tries to spike higher and then it closes higher in a little indecision candle, and then you can see what happened next. It just kept going up. Okay, so but we're talking about basically just at the open. Let's see here. This was kind of crazy, this big candle right here. This must have been a news candle. But essentially, we do not have divergence here. The price opened on the New York session, and we did not have any divergence, and the price did, in fact, wander up higher. So there's no divergence, so you would have stayed with that long. All right, there's kind of a crappy consolidation day right here. But, we had price heading down into the open. This one's just really is not a great one because we were heading down towards the open, and we did not have divergence here. Let's see, did we? Yeah, we did have a little divergence here. So if you'd gone long here, you may have taken a loss on that one. All right. And what else do we have? So this is a market maker liquidity clear out. You can see we came into the session with price going up right here. The stochastic in the middle of the range pointing up. So if you take a long position right here, you would have had a little bit of profit, and then boom, they slammed it down for about an hour or so, and then look at this huge run to the upside. So this is a market maker liquidity grab. This is where the hunting stops right here. So this is a really unfortunate one because, you probably would have put your stop, below this swing, plus the stochastic, plus the ATR. So let me put the ATR on, let's just see how close we would have come to being, probably would have been stopped out. Let me throw the ATR on here. Okay, so at that point, oh boy, we went all the way back here. I don't know why, I hate when it does that, you guys. I gotta go back and find that. Okay, here it is right here. Nope, that's not it. We already looked at that one. Come on. Sorry about that, guys, whenever I do that. Okay, here it is. All right, so below this low right here, The ATR at that point is about 3. So right there, plus 3. This is almost 7. So that's a tough one, guys. You may have been stopped out on that one. So only to see it run up. So like I said, guys, not a perfect thing by any means. But again, guys, your ideal setups is going to be at the open. So if you wanted to just say, you know what, I'm not going to take any of these ones when the price is inside these two lines. It's inside between the overbought and the oversold. Just I'm not going to take them. I'm only going to look for setups when at the open the price is either in the overbought or the oversold area, and I'm looking for divergence. Okay, and then I will take the trade against the trend with the divergence. Okay, and then again, however you want to set your exit or your profit target, feel free to do that. Whether you use a fixed target, whether you use divergence going the other way, or use a trend line break, or some other kind of oscillator, or or whatever it is you like to use for take profit levels. And then, like I said, for stop loss, you should put it above or below the recent swing, and add the spread in at least. Okay, or sometimes people like to go 2 times the ATR for stop loss. So whatever you feel comfortable with, position your risk management properly, and you'll be fine. All right. So that's really it, guys. And you can do this on again any of these futures. They do move pretty well, and they are fairly predictable. Just be careful on news days if there's a news event coming out right at the open, or if there's one that came out just before the open, like a CPI number or some other real financial news item that's going to potentially move the market. Just be cautious on those days, because price can be very volatile at the open when New York opens. Okay, but if there's no big news scheduled right at that open, that's what I would do. And again, the only thing you need to do is mark off. You don't need this indicator. This is just an indicator I have, and this is a free indicator I found online. So if you want to know, let me know. I can, I can let you know where I found it. But you don't have to. Every day right before the open, just take a vertical line and just find your opening candle before it comes. Just mark the spot on the chart, and just wait and see what happens. And then, depending how far you want to go to the right, depends how you set your profit targets. Again, I just happen to have this set for 5 hours or so, but you don't have to do that. All right, and then the only other indicator you need is the stochastic, so you can use it for divergence, and that's about it. So, guys, I hope that helped. And if you're trading these markets, go ahead and give it a shot if you're looking for a simple day trading strategy, and see how it goes. As usual, like I said, just practice good money management. And again, guys, I'll play around with this in Forex, although again, I suspect it probably won't be as lucrative in Forex, but maybe I'll look at the New York Open or something like that, which is the session I trade. I trade New York in Forex. So I'll give it a back test on that at some point. But again, guys, this is in the futures markets. All right. So questions, comments, concerns, guys, leave them in the comments below. Be sure you smash that like button, show some love to the channel, and hit that subscribe button, ring the bell notification so you get notified when I make a new video. And I look forward to talking to you guys really soon in the next video. All right, thanks, guys.